Something unusual is happening in the gold and silver markets right now, and most people do not yet understand the magnitude of what is unfolding. Prices are no longer moving in predictable patterns. Instead, they are swinging violently, rising rapidly, falling suddenly, and then recovering again in ways that resemble the early stages of a much larger financial transition. These types of movements are not normal corrections. They are warning signals. And historically, when gold and silver begin behaving this way, it has often marked the beginning of deeper structural changes within the global financial system itself. To understand why this matters, we need to look at what gold and silver represent. These metals are not just commodities. They are financial barometers. They reflect confidence in currencies, trust in governments, and stability in the financial system. When investors feel confident, they move toward risk assets like stocks. But when uncertainty grows, capital begins shifting towards safe haven assets, especially gold and silver. This shift is not emotional. It is strategic. It is a defensive response to perceived systemic risk. What makes the current situation particularly alarming is the speed and intensity of recent price movements. Silver, especially, has experienced swings of extraordinary magnitude within extremely short periods of time. In some cases, prices have moved double-digit percentages within hours. This level of volatility is rare and historically associated with periods of extreme financial stress. It signals that liquidity conditions are tightening and that leverage within the system is being forced to unwind rapidly. One of the key drivers behind this volatility is the structure of the futures markets. Gold and silver prices are heavily influenced by futures trading, where large financial institutions, hedge funds, and leveraged traders speculate on price movements. These markets operate with leverage, meaning traders control large positions with relatively small amounts of capital. This structure works efficiently during stable periods, but when volatility increases, it can quickly become unstable. When prices begin moving rapidly, exchanges respond by increasing margin requirements. This means traders must deposit more money to maintain their positions. If they cannot meet these requirements, they are forced to sell. This forced selling creates a cascade effect. Prices fall further, triggering more liquidations, which leads to even more selling. This chain reaction can produce sudden crashes that appear disconnected from fundamental supply and demand. At the same time, long-term demand for physical gold and silver remains strong. Central banks around the world have been increasing their gold reserves at historically high rates. This trend reflects a growing desire among nations to reduce reliance on fiat currencies and strengthen their financial independence. Gold provides stability because it is not tied to any single government or monetary policy. It exists outside the credit system. This shift in central bank behavior is not random. It reflects a broader concern about the sustainability of the current global monetary structure. Governments worldwide have accumulated massive levels of debt. Servicing this debt requires maintaining low interest rates and expanding the money supply. However, these policies weaken currency purchasing power over time. As currencies weaken, gold becomes more attractive as a store of value. Silver occupies a unique position because it functions as both a monetary metal and an industrial metal. It is essential in electronics, renewable energy, solar panels, and advanced technologies. This dual role creates complex price dynamics. Industrial demand supports long-term growth, while financial demand amplifies volatility during periods of uncertainty. When both forces align, silver can experience explosive price movements. Another factor contributing to the current volatility is declining market liquidity. Liquidity refers to the ability to buy and sell assets without significantly affecting prices. When liquidity is abundant, markets remain stable. But when liquidity tightens, even small changes in supply or demand can cause large price swings. Recent volatility suggests liquidity conditions are becoming increasingly fragile. Investor psychology also plays a critical role. Markets are driven not only by fundamentals, but by expectations. When investors begin anticipating instability, their behavior changes. They reduce exposure to risk assets and increase allocations to defensive assets. This shift creates feedback loops. Rising demand pushes prices higher, which attracts more attention, leading to even more demand. At the same time, volatility itself creates fear. Rapid price declines shake investor confidence and force weaker participants out of the market. This process transfers assets from weak hands to stronger hands. Historically, this type of consolidation has often preceded major upward price movements. Volatility, therefore, is not merely a symptom of instability. It is part of the transition process. Global economic conditions further reinforce this trend. Inflation remains elevated in many parts of the world. Even when official inflation rates decline, the cumulative impact of years of monetary expansion continues affecting purchasing power. Real interest rates remain historically low relative to inflation, reducing the attractiveness of holding cash. This environment naturally supports precious metals. Currency dynamics also contribute to precious metal strength. The US dollar, while still dominant, faces increasing competition. Some countries are exploring alternative settlement systems and reducing reliance on dollar-based trade. This gradual diversification reduces structural demand for dollars and indirectly supports gold demand as a neutral reserve asset. Financial markets today are more interconnected than ever before. Stress in one area quickly spreads to others. Banking systems, bond markets, equity markets, and commodity markets are all linked through complex networks of leverage and derivatives. When volatility increases in precious metals, it often reflects broader systemic stress rather than isolated commodity-specific factors. Another critical element is debt sustainability. Governments must continually refinance existing debt while issuing new debt to fund operations. Rising interest rates increase borrowing costs, creating fiscal pressure. If markets begin questioning debt sustainability, confidence in government bonds weakens. This process historically drives capital toward alternative stores of value, especially gold. Silver often follows gold during these transitions, but with greater volatility. Because silver markets are smaller, capital inflows and outflows have amplified effects. When demand increases, silver rises faster. When selling pressure emerges, silver falls faster. This volatility makes silver both risky and potentially rewarding. Market manipulation concerns also contribute to uncertainty. Large institutional players possess the ability to influence short-term price movements through futures markets. While long-term trends reflect fundamentals, short-term price action can be affected by strategic positioning, stop-loss triggering, and liquidity targeting. These actions increase perceived instability. Technological changes also affect market dynamics. Algorithmic trading now dominates financial markets. Automated systems respond instantly to price movements, amplifying volatility. When certain thresholds are reached, algorithms execute trades automatically, accelerating price changes beyond what human traders alone would produce. Global geopolitical tensions add another layer of complexity. Political uncertainty increases demand for safe haven assets. When investors fear instability, they seek protection in assets perceived as independent of political control. Gold and silver historically serve this function. At the same time, structural supply constraints exist. Mining production cannot increase rapidly in response to demand. Developing new mines requires years of investment, regulatory approval, and infrastructure development. This limited supply elasticity means price increases cannot be quickly neutralized by increased production. Retail investor participation has also increased. Digital platforms allow individuals to access precious metal markets more easily. This democratization increases market participation but also adds emotional volatility, as retail investors often react quickly to price changes. Institutional investors are also reevaluating portfolio allocations. Diversification strategies increasingly include precious metals as hedges against systemic risk. Even small allocation increases from large institutions can significantly impact prices due to market size limitations. Historical parallels provide valuable context. Similar volatility patterns appeared during previous financial transitions, including the 2008 financial crisis and earlier monetary shifts. These periods were characterized by uncertainty, rapid repricing, and structural adjustment. The current environment shares many of these characteristics. Debt levels are high, monetary policy remains constrained, inflation pressures persist, and geopolitical uncertainty continues. These conditions create a foundation for continued precious metal volatility. Risk management becomes critical in such environments. Volatility creates both opportunity and danger. Participants must understand that rapid price swings can occur without warning. Emotional decision-making increases losses. Long-term trends, however, often emerge from volatile transitions. Structural changes do not occur smoothly. They involve periods of instability as markets adjust to new realities. Gold's role as a monetary anchor becomes increasingly relevant during these transitions. Its independence from credit systems provides stability when confidence in financial structures weakens. Silver's hybrid role amplifies its responsiveness. Industrial demand supports long-term value, while monetary demand increases during instability. The interaction between these forces creates complex market behavior. Short-term volatility coexists with long-term structural trends. Understanding this distinction is essential. Volatility does not necessarily indicate weakness. It often signals transition. Market participants who recognize structural trends can position themselves accordingly. Those who focus solely on short-term fluctuations may misinterpret signals. Financial systems evolve over time. Periods of stability are followed by adjustment phases. Precious metals often play key roles during these adjustments. The current volatility suggests markets are entering such a phase. This does not guarantee specific outcomes, but indicates elevated systemic uncertainty. Monitoring central bank actions, interest rates, inflation trends, and currency dynamics provides insight into future direction. Precious metals reflect these forces more directly than many other assets. The coming period will likely remain volatile. Price swings will continue reflecting underlying uncertainty. These movements should be viewed within the broader structural context rather than isolated events. Markets are not random. They respond to economic forces, policy decisions, and investor behavior. Gold and silver currently reflect a system undergoing adjustment. Volatility represents the visible expression of deeper changes. Understanding these dynamics provides perspective. The situation continues evolving, and the signals coming from gold and silver suggest that the financial system may be entering one of its most important transition phases since 2008. Stay safe.